Have you ever wondered how business owners actually pay themselves? If you're running a sole proprietorship, partnership, or LLC, the answer isn't as simple as writing yourself a paycheck. In fact, paying yourself the wrong way can create tax headaches, bookkeeping issues, and even compliance problems. In this video, we'll break down exactly how to pay yourself based on your business structure and the common mistakes you should avoid. The way you pay yourself affects more than just your personal income. It impacts your taxes, business cash flow, financial records, and overall compliance. Many entrepreneurs mix personal and business finances, especially in the early stages, but that can lead to major problems later on. Keeping a clear separation is essential for long-term success. Let's start with sole proprietors. A sole proprietorship is the simplest business structure. Legally and for tax purposes, you and your business are considered the same entity. Because of that, you don't pay yourself a salary. Instead, you take what's called an owner's draw. This means transferring money from your business account to your personal account whenever cash flow allows. It could be weekly, monthly, or on any schedule that works for your business. Here's the important part. You're taxed on the business's total profit, not on the amount you withdraw. For example, if your business earns $100,000 in profit and you only withdraw $60,000, you'll still pay taxes on the full $100,000. Now let's talk about partnerships. In a partnership, owners typically receive compensation through partner draws or distributions based on the partnership agreement. Partners aren't considered employees of the partnership, so they generally don't receive traditional paychecks. Instead, profits pass through to the partners, who then report their share of income on their personal tax returns. Similar to sole proprietors, taxes are based on profit allocation, not simply on cash withdrawn. LLCs can be a little more complicated. How you pay yourself depends on how the LLC is taxed. If you're a single-member LLC using the default IRS tax treatment, you'll usually take owner's draws just like a sole proprietor. If you own a multi-member LLC, members typically receive distributions or guaranteed payments based on the operating agreement. However, if your LLC elects to be taxed as an S corporation or C corporation, you may be required to pay yourself a reasonable salary through payroll before taking additional distributions. No matter which structure you have, follow these best practices. Keep separate business and personal bank accounts. Track all draws and distributions accurately. Set aside money for taxes throughout the year. Avoid treating owner's draws as business expenses. Maintain clear bookkeeping records. These simple habits can save you significant stress during tax season. The bottom line is simple. Sole proprietors usually pay themselves through owner's draws. Partners receive distributions according to their partnership agreement. And LLC owners may use draws, distributions, or salaries depending on how the LLC is taxed. Understanding the rules for your business structure helps you stay compliant, manage cash flow effectively, and avoid costly tax mistakes. If you found this video helpful, don't forget to like, subscribe, and share it with other business owners who may have the same question. Thanks for watching.